Good morning, everybody, and welcome to the Schulte Asset Management fourth quarter conference call and annual report of event-driven special situation, our distressed webinar and teleconference. Just as a little housekeeping and a disclaimer for the moment, this call is for our investors only. If there's any media or press on the line, please disconnect and be in touch with us directly later today. Our review and presentation may contain non-public information and is subject to confidentiality agreements. Please see our disclaimer in the back of our presentation materials for further details. Please note also that this webinar and teleconference call is only a generalization and summary of our views, and for a more detailed review and examination of our thoughts, please see our detailed quarterly annual letter that we have uploaded to Syntrack, our virtual data room. If you have any technical issues during the call and the webinar, please email us at investorrelations@samco.net. Additionally, at the end of the call, and you will see this on the final slide, we'll have an opportunity for questions and answers after the formal presentation. And as I said, there'll be instructions on the screen to quote how to raise your hand and then ask a question. So we'd like to lead off our presentation this morning with our overall executive summary and highlight just a couple of highlights, and then I'm going to be going through some of these slides. George will take over, and then we'll wrap it up and go to Q&A as well with Dean Crowder. As we know, the U.S. economy continues to grow very solidly and very stable with good growth engines behind it. As we know, the GDP is right now at 2.5%, unemployment at all 17-year lows. Although, as we're going to see in some of our bulletin and our conversation, inflation is creeping back into the system and therefore putting upward pressure on interest rates. The recent U.S. Tax reform legislation we expect will boost GDP by about 1 to 2%, increase overall cash flow and earnings. As we've seen much discussion in the media, we even think that the media is underestimating it, especially as it relates to the repatriation of capital from overseas. And that's going to be an important driver going forward in the 18 and even beyond timeframe. Additionally, U.S. deregulation and as well as the pending and potential infrastructure and defense initiatives will further boost G&A and continue to be a great tailwind for overall corporate earnings and especially for some of the companies in our portfolio. We think and feel that, the Fed tightening here is going to continue to put downward pressure on overall fixed income markets as well as long treasuries, and we're going to see in some of our slides force default rates higher. We here at Schulte in our portfolio are very opportunistically positioned for this and are expecting that change. As many of you know, our 17 performance in our liquid fund was excellent this year. We returned 18.4 in our domestic fund and a little more than 20% in our offshore fund, well ahead of our peers. We're very proud of that performance and look for continued growth in our portfolio as this year continues. The primary driver were post-org equities, where we executed well in culling our losing and underperforming positions, and our portfolio remains very cheap at a little more than 3 times EBITDA versus the market up in the 13 times range. We continue to see many opportunities ahead of us, and we look forward to continue to working with you in 18. I think it's important to touch on the most recent market volatility that really broke out in the beginning of February. We had a tremendous and a very strong January, as many did, given the strength of the market. It was probably a little ahead of itself at that time. And we haven't published our numbers, but for January, we were probably up close to 10%. We've given, obviously, some of that back in early February. We remain ahead of the S&P at this time, and we're very gratified by that, managing the storm and managing the volatility well, which we really we feel have done a good job with. As I pointed out, our performance was strong in 17. We look for continued good outperformance in 18. Importantly, I want to bring your attention to the cumulative return slide, the graph below our liquid share class, which highlights our performance, which is the thick line, versus our peers. Those are all the different hedge fund indices in our strategy, whether it's multi-strategy or event-driven, and we're very proud of our outperformance this year. As you can see that the outperformance is about 800 bips from the last competitor index. So we think that was very favorable and look forward to continue to execute well for you, our investors and partners. Moving along in terms of the overall macro, we discussed what GDP is, unemployment, CPI, which following yesterday's number is a tick higher than here, but nonetheless is really putting upward pressure on overall rates, as well as the 10-year Treasury, which we know is climbing very close to 3%, and I'm sure we'll get there shortly. Importantly, monetary policy remains accommodative and friendly, albeit with a good but there, as we put it there, because the Fed will continue to raise rates. They've raised rates 5 times since 2015. We are expecting more this year. Most estimates are for at least 3, maybe more, and the Fed continues to unwind the balance sheet in reverse quantitative easing, or many folks refer to it now as quantitative tightening, and we continue to see that and expect that to have impact on the overall markets as well as our opportunistic positioning. Overall fiscal policy, again, we highlight the tax cuts as well as deregulation and increased spending, but all again, it really funnels down into the overall inflation risks, where we would continue to reiterate to avoid long maturity fixed income securities. We would go as far as being short them as well and locking in fixed borrowing costs. These historic lows will not be around for much longer, in our opinion, and we remain focused on value-oriented post-distress equities that really don't fit into the overall large passive trading of ETF mandates, etc. And just a little note on that, I think that we all know through the media as well as what we experienced about a week or so ago in the market, which is definitely not over in all likelihood, but the packaged products and ETFs and ETNs that really were very contributing to that huge volatility, whether they were index related or not, are still in the background, in all likelihood will come back and play a role in the volatility. And I think one may extend that to overall passive investing, where we really don't know the consequences of the tremendous inflows that have been there in any market volatility, and highlights once again the importance of active management for firms and managements that have really been through different cycles, as Schulze has. So once again, just finally, our equity portfolio trades at 3.2 times EBITDA versus the market a little more than 13 times. Again, we continue to be focused on overall event-driven catalysts within our portfolio, whether they're buybacks, M&A, special dividends, free cash flow that continues to grow. Importantly, this slide with the junk bond and leveraged loan debt issuance as well as outstanding default rates is really key to our overall thesis going forward. As you can see on the left-hand graph, where issuance is completely at a new bubble-like level for 2017, with default rates extremely low. We expect default rates to increase slightly in 2018 to 2.5%, and there are some estimates looking out to 19, which I think is really important, of as high as 5 to 6% in terms of default rates. And as we approach that kind of default rate level, we are definitely going to see some of the junk bond and leveraged loan bubbles burst, creating much greater opportunities in the default and distressed public debt side. But also for our strategy, we expect to see many more opportunities on the short side. Historically, as default rates rise, the short opportunities for our strategy increase, and we look forward to taking advantage of that as 18 rolls out and we look into 19. Finally, before I hand off to George, just a highlight of the 10 largest defaults in 2017. Once again, it was the lowest default rate since 2013 in terms of companies defaulting on their debt. As I said, we expect that to begin to bounce in 18 and accelerate into 19. And in the meantime, there's still great opportunity in our portfolio as well as in the post-distressed equities marketplace. I'd like to now hand it off to George to highlight the distress trends and go through the highlights of our portfolio. Take it away, George.
Hey, thank you, Bill, and thank you everybody for dialing in this morning. So turning to slide 8 here with the overall distress trends, it's really amazing across this list of industries that we've followed for the past 20 years or so, there are numerous catalysts that we're seeing these days, and those are spin-offs, stock buybacks, and M&A activity. Nearly every industry listed here has post-distress equities trading, and that's very interesting right now for our strategy and the way we've positioned the portfolio in light of the overall default cycle. But just going through some of these names, I'm going to give some examples. Under auto manufacturers, we see GM and Fiat that both emerged from terrible distress just a few years ago, trading as post-reorg equities. With casinos, we're seeing Caesars, and we'll talk about that one in a minute, which was the largest casino bankruptcy ever. On the coal side, we've seen a lot of activity, and we'll talk about several of these names, but just to list them quickly, Warrior, Met Coal, Arch Coal, Peabody, and Contura are a number of those names. In the energy space, and that's more oil and gas, we'll talk about Energy 21 in a few minutes. On the financial services side, of course, most major financial services companies were insolvent just a few years ago, dating back to 2009 and 10. We'll talk about Bank of America in a few minutes. And the government side, there's still some nearly bankrupt governments or currently bankrupt governments, like like you see in Puerto Rico, which is the largest municipal bankruptcy we've seen ever. Just going down a couple more bullets here, the litigations claims. There's a lot of activity there. We'll talk about the Motors General Unsecured Creditor Trust in a few moments. That's the trust that emerged from General Motors' bankruptcy. On the publishing side, you're seeing a lot of secular change that's driving bankruptcies. A recent name that we've looked at and that we've had a number of years of experience with is a company called DexYP. Going down the list, a couple more to retailers. It still looks like Sears is on its way into bankruptcy sometime soon. There's a lot of secular change in that industry, and Macy's is another one that we looked at during 2017. In shipping, it was just a short while ago that most major shipping companies were in bankruptcy, and we continue to hold a position in one name called Overseas Shipholding Group, which we'll talk about in a few minutes. Telecom and retailers, by the way, I think those two industries will probably lead the next default cycle, just because of the amount of debt that they have outstanding, as well as the secular change. And we'll talk about one example in the telecom space in a few minutes, and that is Windstream, which is a legacy operator. So with that, let's turn to the next sheet, and we'll go through some of the portfolio highlights, please. Thank you. Just to reiterate what Bill was saying before, we had a great year last year, and performance has remained strong for the first part of this year as well. I attribute most of that success to our team's ability to not just identify and make investments in good, solid, underpriced companies on the long side and overpriced companies on the short side, but also more importantly, I think is really letting winners run and cutting losers, the culling of losers. That's helped us generate a very high win-loss factor, which is the ratio of total gains versus losses. And if you look at the middle of this page, you can see the win-loss factor by security. Since most of our positions last year were post-distress equities, to have almost a 3 times win-loss factor there is an important achievement for us. And you see the exposures in our portfolio as of December. Those have changed a little bit since then. Today in our portfolio, they're slightly different. And for those investors that are doing extensive due diligence on us, feel free to call us after this conference, and we can go through our current exposures with more detail if you'd like. So let's go into the portfolio section, which is always our favorite part of these conference calls, or at least mine. The first one I want to talk about and review, and what we've done, as we always do, is we're going to go through in a balanced way the top 5 winners and losers in the portfolio. The first one is in the coal space, Arch Coal. This is about 6% of our portfolio weight as of year end, and it's a position where we were long the post-distress stock of Arch. Our cost for this stock is about $40 a share, and it's currently trading at about 93. Our target price for Arch stock is 135, which would be an additional 45% appreciation. This is a leading U.S. coal producer that operates metallurgical mines in Appalachia as well as it's also the second largest producer of coal in the Powder River Basin in the U.S. It came out of bankruptcy in October of 2016, after eliminating about $6 billion in liabilities subject to compromise. And with that, they were able to reduce their interest expense from nearly $400 million per year to just $23 million now for this year. In their year-end conference call, management for Arch Coal reported that they returned $326 million to shareholders via repurchases and special dividends. And those catalysts help reduce the total share count to 16% and also drive up the price of the stock from about $40, where our cost was, as I said earlier, to today's price of about $93. In 2017, this company generated slightly over $2 billion in revenues and about $418 million in adjusted EBITDA, and that it compares very favorably with its total enterprise value of about $1.6 billion at only 3.88 times. And going forward, projecting ahead to 18, the TEV to EBITDA multiple for Arch is only 3.83 times. So obviously, very inexpensive for one of the largest coal operators. Separately, and we're seeing this across almost every company that we look at, Arch is benefiting from the new tax cut laws. In Arch's case, they'll receive a $35 million tax refund because of the recent elimination of the U.S. corporate alternative minimum tax. Now, Arch already had big net operating loss carryforwards, so it'll pay zero in taxes for the foreseeable future. But on top of that, they're also getting a $35 million tax refund. So turning to the financial services space, Bank of America, we've been in this position for some time. In fact, our cost for B of A stock is $7.36 a share. Currently, it's trading at about $32, and our target price is about $40, which would be an additional 25% appreciation. Now, Bank of America is particularly interesting because of how it should benefit from rising interest rates, which we are forecasting and which we think are very likely to continue. People on the call, I'm sure, know that this is one of the largest financial institutions in the world, has about 47 million consumer and small business relationships, and importantly, it has about 1.3 trillion in customer deposits as of year-end. They're ranked in the top three among most of their competitors versus across all business lines, including leverage loans, high-yield corporate debt, investment-grade debt, et cetera. And this company, as I alluded to before, has evolved tremendously since the 2008-2009 period, when Bank of America and most other major financial institutions were facing insolvency before they got bailed out or merged. For last year, management reported the highest run rate of earnings in the company's history, going back to 1874, at over $21 billion. And as a result, they increased their shareholder dividend by 60% and continued a large stock buyback program that they've had going for some time. In fact, last year, they returned $17 billion to shareholders through about $13 billion of stock repurchases and $4 billion of dividends. And then at year-end, they also announced a new $5 billion buyback authorization. Interestingly, Warren Buffett is now the company's largest shareholder after having converted the warrants that Berkshire Hathaway received during the financial crisis. Now, going forward, again, we're excited about how this company will evolve with higher interest rates. As interest rates climb, and the Fed funds rates and target interest rates are the base rates for most of Bank of America's nearly $2 trillion in earning assets. So as interest rates climb, B of A gets to push through the higher interest rate onto its borrowing customers. And on the other hand, it's 1.3 trillion in customer deposits. The interest rate on those, or the cost of borrowing for B of A, is relatively sticky. So we're expecting higher net interest margins going forward, net interest income. For 2017, that number was about 3.1% at $61 billion. and going forward, we expect it to climb even further. Let's turn to the casino space. Caesars, which was again one of the largest casino bankruptcy of all time. This company, our cost for the new post-distress stock is $9.87 per share. It's currently trading at about $12.80, and our target price for it is $22.60, which would be an additional 77% appreciation from where it's currently trading. The stock was up during the quarter at a gain of about 32%, but this was more than offset by the company's losses that we saw in the company's pre-petition bonds, which were swapped for a package of new securities when it emerged from bankruptcy. For those who don't know, Caesars is the world's most geographically diversified casino company. It has roots dating back to 1937, and it operates on 3 continents with some well-known brand names like Harrah's, Caesars, and Horseshoe. It has 47 casinos across 14 states and 5 countries, and it's number 1 or number 2 market share position in most of its markets, and it's also number 1 in terms of theater venues in the U.S. and number 3 for live entertainment. When it emerged from reorganization, it eliminated $16 billion in debt, so you can get a sense for the scope of this business. And its total annual fixed charges were reduced with that restructuring by $1.6 billion per year. Now, the company hasn't reported year-end numbers yet, but they've reported a number of positive developments since reorganization. 50% of all their rooms were renovated last year, and they're anticipating that it'll be closer to 88% by the end of 2020. Very strong fundamental trends in the Las Vegas market where they operate. Also, during restructuring, this company increased EBITDA by a little bit over $750 million. So big gains there. And for the third quarter of last year, they generated a 14% increase in EBITDA. Since quarter's end 2015, third quarter of 2014, they also announced the acquisition of Centaur, which is a company that has 2 racing properties and a casino in Indianapolis, and that was funded internally via a sale-leaseback transaction. They also announced the refinancing of all their remaining subsidiary debt, thereby reducing interest expense by another $290 million. So very good trends with Caesars and a strong management team, certainly doing everything they can to reward their post-distress equity holders. The valuation is attractive at only 9 times projected EBITDA, while the peers trade at closer to 12.5 times. Let's turn to the oil and gas space with Energy 21, which is about an 8% portfolio weight for our fund as of year end. It's another long post-distressed stock position. Generated a loss for us during the quarter, but there's some very interesting developments going on with this company, which we think give it substantial upside from where it's currently trading. Our cost for Energy 21 stock is $7.10 per share. It's currently trading at about $5.50 per share, and our target is over $35, closer to $40 per share for Energy 21, which would be a 6-bagger versus where it's currently trading. This is an independent oil and gas exploration and development company. It has properties in the U.S. Gulf of Mexico waters, as well as some properties onshore. It operates 9 of the largest oil fields in the Gulf of Mexico, with 109.4 million barrel of oil equivalent in terms of proved reserves, and an additional 67.5 million barrels of oil equivalent of probable reserves. We estimate that the probable reserves alone are worth about $17 per share, and that's obviously very attractive versus current prices of about $5 to $5.50 per share. Energy 21 stock has been down for several reasons. One is just the uncertain outlook for oil prices, which we think are now stabilizing at well above Energy 21's break-even cost. There has also been some concern with this company over its potential need for additional future outside capital for drilling, which we think has now passed. That requirement has passed due to higher oil prices and higher cash flows that have come with that. And then most importantly, and this is really what I think has created this arbitrage opportunity, is that there's a non-natural owner of Energy 21 stock, which is a bond mutual fund. It's called Franklin Funds. At one point, that fund held about 30% of all Energy 21 stock, but they've since reduced their position to about 8%. So they've been a forced seller. They received the stock through the bankruptcy, and obviously they didn't want to hold it. And so they've dumped it, in our view, without regard to the underlying fundamentals of the business. Energy 21 came out of bankruptcy in December of 2016, right before New Year's, after eliminating close to $4 billion in debt. And today it has a market capitalization of only $175 million, or if you net its debt and cash, the market capitalization is tiny. It's only $44 million versus about $160 million in last 12 months EBITDA through September. And that multiple at 0.3 times is something that honestly I don't think I've ever seen in my 20 years of running our firm and in nearly 25 years of investing in distressed securities. So management is also excited about the opportunity for Energy 21. We've spoken with them a number of times. They recently, the CEO recently purchased $120,000 worth of stock. So we're looking forward to reporting on this as Energy 21 most likely has success going forward. Let's turn to the shipping industry with International Seaways. This position generated a loss for us during the quarter of about 12%, and so we sold the entire position. Just by way of background, this tanker business was originally spun off from a larger company called Overseas Shipholding Group back in December of 2016. And the purpose of that spin-off was really designed to make both businesses simpler so that their investors could understand them better and also allow for a more efficient return of capital to shareholders. So International Seaways, it had a good management team. It had good assets, 55 ocean-going vessels with good upside, as well as a good balance sheet after the company came out of reorganization. But the stock drop in this case triggered our risk guidelines, and that's why we sold it. Having said that, we've maintained a position with Overseas Shipholding Group, and that is one of the largest operators of U.S. Jones Act vessels. It has very high market share, as you can see here, about 21% for U.S. tankers, 100% for shuttle tankers, also 100% for lightering articulated tug barges. So it's one of the main operators in the U.S. Jones Act trade. For the 12 months ended September, it generated about $400 million in revenue and $138 million in EBITDA, and this compares very favorably with the Overseas total enterprise value of only $351 million. Since then, management has commenced efforts to refinance its term loan, which we think will shortly be concluded, and pro forma for that refinancing, leverage will be down to only 2.2 times projected EBITDA. So the business trades at about 2.5 times EBITDA, which is a sharp discount to industry peers, and we think OSG has a lot of potential upside from there. Most likely, there will be some catalyst that will drive it closer to fair value, perhaps M&A, or perhaps a conversion of the business into an MLP type structure. Let's turn to a completely uncorrelated investment, the Motors Liquidation Co. GUC Trust. This is a litigation-related investment. It is the trust that was formed for the benefit of General Motors, general unsecured creditors when General Motors came out of bankruptcy. Our cost for this position, and there are units that trade under ticker symbol MTLQU. They're currently traded about $9.20. Our cost is about $9.25, so pretty close to market value. Our target value for the position is $15 per share, which would be, a little bit over a 60% gain. So this trust was initially formed, again, for the benefit of GM unsecured creditors. And the way it works is that the trustee administers and distributes certain assets that were set aside for those former creditors as and when the court approves general unsecured claims that were on the docket. The trust was initially funded with 150 million shares of GM, as well as 2 tranches of publicly traded GM warrants of 136 million each, the Class A and the Class B warrants. And since GM emerged from bankruptcy back in 2011, the trustee has made numerous creditor distributions, and eventually they also sold all remaining GM securities that the trust owned. And so now the trust has just over $500 million in cash with no other assets as of December. For the trust, there remain 2 disputed claims. One is called the term loan avoidance action claim, and the other is the potential ignition switch recall claims against GM and the trust. So the background with the term loan avoidance action is that pre-petition lenders to GM, secured pre-petition lenders, received a $1.5 billion repayment of their term loan right before the company filed for bankruptcy, but after receiving bankruptcy court approval from the bankruptcy judge. That amount was repaid with proceeds from the new debtor in possession loan when GM went into bankruptcy. Since that time, claims have arisen against those lenders under the theory that they were undersecured and therefore weren't entitled to full cash payment and really should have been in the unsecured creditor pool and thereby get recoveries only as an unsecured creditor. There's been a lot of litigation, a lot of back and forth. It turns out the whole genesis of that claim is based on a mistake that the law firm that represented GM made in terms of not properly filing a UCC statement to perfect the security interest that the creditors had on a number of plants and assets. However, and this has been our theory all along, the term loan lenders were also secured by fixtures that GM had, and we've always estimated that those fixtures alone were worth more than $1.5 billion. So there was a favorable trial that concluded last year for this trust, where the judge looked at 40 representative assets, 40 out of 200,000 fixtures, to determine what their value was, and to thereby determine whether or not the lenders were properly secured. The outcome was favorable for the trust, and in fact, we expect that this claim will ultimately be settled for nothing, or very close to nominal value. Although it is still under appeal, so there's still some uncertainty there, but we think that the appeals will eventually drop. The other claim against this trust is the ignition switch recall claims that arise from economic damages potentially for claimants who owned GM vehicles that were subject to the massive 31 million vehicle recall that GM started right after, or a few years after emerging from bankruptcy due to ignition switch problems. Now, we think that claim will also settle for nominal value, and the main reason is, well, there are 2 reasons. One, there's an accordion feature in the original plan of reorganization where if claims exceed a certain dollar amount, GM must contribute new cash and securities into the trust. But the other, and this is probably the more important reason we think the trust will succeed in this second claim, is that the plaintiffs are more likely to pursue and ultimately obtain a recovery from GM, because if they get a direct recovery from GM, that amount won't be discounted like payment from this trust would be for them. So we're pretty confident that both of these claims will be resolved for nominal value, and as a result, over time, Motors Liquidation Trust unit holders, including our fund, will ultimately get full NAV of about $15 a share versus currently its price at about $9.25. So clearly, as you can see, this is an off-the-run investment that's not correlated with the overall markets. It's very much dependent on these 2 litigation outcomes, which we have analyzed and we're comfortable with. And if anybody is interested in learning more about it, there's certainly a lot more detail about this case in our year-end letter, but also you're welcome to call us to discuss it some more. Let's go back to the coal industry with Peabody Energy, which is another long post-distress stock representing about 6% of our portfolio weight. It had a return during the quarter of almost 40% at 36%. Our cost for Peabody stock, ticker symbol BTU, is about $24.25 per share. It's currently trading at about 41, and our target is $75, which would be an additional 81% appreciation from where it's currently trading. This is the world's largest private sector coal company, and it produces both metallurgical and thermal coal in over 25 countries, or it serves customers in over 25 countries. Its mines are mostly in the U.S. and the Powder River Basin, as well as the Illinois Basin, and they also have some mines in the Asian Pacific markets. The company in 2017 generated just under $6 billion in revenues and sold almost 200 million tons of coal. And this was the largest coal bankruptcy. It filed for bankruptcy in April of 2016 and emerged in March of 2017 after eliminating almost $7 billion in debt. Now we're seeing a lot of favorable catalysts with Peabody. In their year-end call, they reported strong earnings, and as a result, they paid down an additional $200 million in debt. They also repurchased $107 million of stock during the quarter, and they initiated a new quarterly dividend. In addition, they upsized their revolver by $350 million, and that allowed them to also release restricted cash of $175 million. And finally, Peabody management converted the remaining preferred stock that the company had outstanding, which was dilutive to existing shareholders. We also elected to convert our remaining preferred stock that we owned in BTU, and as a result, the company has transformed tremendously since reorganization. It trades right now at just 2.9 times EBITDA, and again, we said, as I said earlier, we estimate its true value at closer to 75 versus its current price of about 41. Another company in the casino business, Tropicana, on page 17 here. We've been involved with this one for some time. Our cost for this position is $30.35. Today it's trading at about 57, and our target price for Tropicana is 85, which would be close to 50% additional appreciation. This is a regional operator, generated pretty good gains during the quarter of about 20%, and it came out of reorganization several years ago in 2010 after I helped negotiate their plan of reorganization. In that plan, Tropicana's debt was reduced by $2.5 billion, thereby reducing interest expense by $125 million. And for any investors that have been with us for some time, you'll recall that Carl Icahn is the biggest shareholder of Tropicana now. He came in to the credit after we negotiated the plan of reorganization. Today, he owns almost 85% of the stock. The business trades at just under 7 times, while the peers on average trade at 11 times, so you can see the discount there. And interesting catalyst here with Tropicana last year, a Dutch tender offer that Carl Icahn worked on together with the company, where they bought back about 13% of all the remaining stock at $45 a share. That reduced the float and drove the stock price up to where it is now, over $50 a share. One other thing about Tropicana that's important to mention is that they've just announced the opening of their new Evansville, Indiana casino, and we expect that will drive substantial additional growth. There's some more details about it in the final bullet there on page 17. But let's go back to the coal space with Warrior Met Coal, and then we'll review Windstream as well before I turn the call back to Bill and Dean. Warrior Met Coal, another coal company. This was printed before the company reported their results, which were yesterday. Yesterday, their year-end results came in above consensus. Their EBITDA for the fourth quarter was $86 million versus $81 million of consensus, and as such, the stock is looking pretty good this morning. During last quarter, Warrior Met Coal, ticker HCC, generated a gain for us of about 75%. So this is a large-scale, low-cost, U.S.-based producer that generates mostly metallurgical coal. It has 2 underground mines in Alabama. It's interesting how it was formed. This company purchased Walter Energy's profitable operations out of bankruptcy through a 363 sale. And Walter Energy, for those people here who follow the coal market, it was formerly a publicly traded pure play coal company with roots going all the way back to 1946 before it filed for bankruptcy in 2015 when most coal companies were bankrupt. So in April of last year, Warrior Met Coal priced an IPO at $19 per share. And our cost for the stock is $26.32. It's currently trading at about 31. Our target for Warrior Met Coal is approximately $50 a share, which would be an additional 62% appreciation from where it's currently trading. Now, this company has had numerous major accomplishments, and they're very catalytic, event-driven announcements. For example, they paid a $190 million special dividend in the first quarter, which represented which amounted to about $3.61 a share. Then they also initiated a quarterly dividend. They ramped up production at their second major mine number 8. They had a massive beat in EBITDA of $189 million for the second quarter. And then look at this. They paid a $600 million special dividend, which was more than $11 per share in October last year. Then for the for the third quarter, they also reported a big increase in revenues, almost 300%, with $100 million of quarterly EBITDA. And finally, a little bit off the beaten track in terms of taxes, Warrior was able to secure an IRS private letter ruling holding that the firm's massive net operating loss carry-forward tax assets would not be subject to an annual use limitation. So the net effect of that is that Warrior will pay a very small amount of cash taxes going forward. In yesterday's call, their management also announced that, like Arch Coal, that Warrior will be receiving a refund for corporate alternative minimum taxes paid as well. So good new developments, not just fundamentally for Warrior with the coal industry, but also with taxes and certainly with their cleaned up balance sheet and their low valuation. As of the print here at $27.25 per share, Warrior traded at only 2 times enterprise value to EBITDA. So clearly another cheap company with interesting catalysts that are driving it closer to fair value. So the final one I'll talk about today is in the telecom space, and I do want to highlight that we expect that telecom companies will be one of the industries that brings us into the next default cycle. This is Windstream, a position where we are long post-distress stock. It generated a slight loss of 8% during the quarter, and we've reduced the size of the holding because it's been triggering our risk guidelines lately. It's a leading U.S.-based telecom company that offers network communications, technology solutions. It has bundled services, including broadband, security solutions, voice and digital TV, as well as data and cloud solutions. And importantly, Windstream has a 125,000-mile fiber optic network, which is they made big investments in that, and so their business benefits from that investment. Our cost for Windstream stock is just under $2 a share at $1.96 per share. It's currently trading at about $1.50, and our target for this is much, much higher. We think that this business is probably worth high teens or low $20 per share, which would be a big multiple on its current trading price. We bought into this stock after it became oversold when the company canceled its dividend. When they canceled it, they replaced the dividend with a stock buyback, which we think was good news. But the dividend had previously yielded 15%, and it had attracted a number of yield-oriented owners. So those yield-oriented owners became forced sellers, and that drove the price down of the stock by about 45%, which is what first piqued our interest. Then separately, one of its bondholders, a firm by the name of Aurelius, initiated a lawsuit which alleged that the company, that their prior sale-leaseback transaction was a fraudulent conveyance and therefore had caused a default under its bond indenture. We've looked at this legal claim. We think that Windstream will ultimately prevail on it, but the announcement of that claim and a couple of news articles about it have generally driven the stock down even further. So today, Windstream trades at just 3 times current EBITDA, or 5 times adjusted EBITDA versus, 5 times adjusted enterprise value versus EBITDA if you adjust for the lease payments that they make under the sale-leaseback transaction that occurred several years ago. And we think that's simply far too cheap for this business. But we have reduced it given its volatility and given its downside risk, but we're still optimistic about its outlook. So that concludes the individual names section. As I said in the beginning, and as we normally do, we include both winners and losers during the quarter. I think the key takeaway, though, is that we really focused and let our winners run while cutting losers, and that gave us a nice high win-loss ratio of about 2.1 times, which is in our firm's 20-year history. In any year where we do that well, we tend to outperform the markets, and so that we're trying to focus on that again this year, as with any year. But with that said, I've spoken a lot, and I'll pass it back to Bill and Dean. Thank you, everybody.
Thank you very much, George. Now I'd like to hand it off to Dean to wrap it up, and then we'll go into Q&A right after that. So take it away, Dean.
Thanks, Bill. And George, some excellent insights on the portfolio, some exciting comments on our holdings. Thank you. I just want to summarize a few key points, why Schulte, and give you some updates on business development activities. So why Schulte Asset Management? Why invest? Well, number one, I think you've got the message here. One of the most promising strategies going forward in this environment we're in presently, and that seems to be continuing to develop. First point, we want to stress, and Bill did an excellent job on this. 2017 was an outstanding year for Schulte, outperforming our peers by over 800 basis points, 8%, 20% on our offshore fund, almost 21% on our offshore fund, and also outperforming the S&P 500. The two main market drivers, monetary policy in the macro environment or fiscal government policies, are very, very favorable to our particular strategy. On the monetary side, we see the Fed continuing to raise rates and this reverse QE scenario to continue. And on the government policy side, much more expansionary activities to include new tax legislation, which we've already seen pass, infrastructure, defense spending initiatives, deregulation across so many industries that we're participating in, and a very interesting point of repatriation of capital, huge amounts of capital coming from overseas back into the United States that will also be deployed in the markets. But so far in 2018, it's been a challenging time. We all know February has been very, very challenging. The big takeaway, of course, is very simply the equity market exposure makes much more sense than fixed income in these rising interest rates. And what has worked to date, passive investing, taking a shortcut, and ETFs, ETNs, we're finding now that is being tilted more toward active investing. So we're excited about that because that's where we're positioned. Our portfolio holdings are extremely cheap at a deep discount. As been mentioned, 3.2 times EBITDA to 13 times for the market. And we expect catalysts to continue to develop. That's one of the most exciting things about our strategy. These catalysts continue to drive valuations up toward much more realistic valuations. And finally, the junk bond debt issuance continues to grow. We see a bubble developing in the space. George has been looking at pre-bankruptcy shorts, strategizing in the portfolio, how to take advantage of this coming bubble bursting at some point, and bringing many more distressed opportunities to consider. So let me switch over to some of the activities that we've seen happening here in the business development area. As George mentioned, Schulte operates using a team approach from investment analysis and portfolio management right down to marketing and business development. Our story, the story of Schulte, is really resonating among prospective investors, and that's seen through a daily effort in calls, meetings, and conferences. And for marketing, one of the greatest benefits to what Bill and I do is outperformance versus our peers and indices. And in turn, investors become more curious. We saw that in fine fashion at this Contact Summit conference in Miami. This is now the industry's largest alternative investment conference. And we had over 30 meetings in 2 days. That's a record for the firm. A lot of curiosity as why is Schulte doing so well? How are they outperforming here? What are some of the new portfolio techniques and things that have been brought forth into play here that are returning such dramatic fashion? We're addressing investor preferences and specific investment needs. Certain geographic jurisdictions like Europe require a structure called UCITS, that's an acronym, for undertaking collective investment in transferable securities. And what that really means, it's very similar to a U.S. mutual fund in Europe, but with some portfolio management liquidity requirements. And we have a number of potential partners for such a UCITS structure that will provide additional marketing assistance in Europe. And we hope to have that fund, that UCITS fund, in place sometime in the summer. In addition to limited partnerships and separately managed accounts, SMAs, which Schulte's always offered here in the U.S., many investors now prefer investing through platforms, which are a structure of SMAs, whereby an accredited investor or an institution can select one fund like ours, or custom design a portfolio to their needs. And we're in advanced talks with one of the world's premier investment consultants and hope to launch this platform relationship in the summer as well. So having the right investment structure now in today's market, particularly in certain geographic locations, along with choices to accommodate both large institutions seeking an SMA or direct fund investment, or for smaller investors where we can aggregate their investments and they need a platform or liquid-oriented structure, is really essential to building out a robust business model at the firm. And getting back to Contact Summit in Miami, during our last quarterly call, we spoke of the Retosa conference, a family office conference in November. During that conference, it was very successful to our benefit and marketing. George accepted an invitation to become a regular contributor on CNBC Arabia, and they have an audience of 50 million viewers and listeners throughout the Middle East and Asia. Since December, George has already been interviewed 4 times, and this relationship continues to open up an entirely new marketplace for Schulte. We're really excited about that. Retosa is also holding another conference in March in Dubai, March 13th and 14th. George will be part of the keynote panel and hold meetings over the course of the next 2 days that follow. And then immediately after that conference, we're off to Latvia for a conference being arranged by a great friend of the firm and advisory board member, Gene Solotarev. And that's the International Investment Conference, his 22nd one that he's put on there in Latvia and Eastern European investors. So we think that affords us wonderful opportunities to raise assets. Just a side note here, Schulte's most recently affiliated full-time employee is Gary Julian. He's been an active member of our advisory board for some time, but Gary is now leading the firm's co-investment opportunities and SPAC opportunities units, whereby investors can assume direct equity ownership in individual companies. And we're excited about this, a new initiative, and you'll hear more about that in the coming months ahead. So there's a lot of very positive marketing activity taking place, and we continue to broaden and accelerate it with a growing degree of investor interest in event-driven and distressed investment opportunities. And so we turn it back over to Bill and to George. I want to thank you for taking time today to hear the Schulte story. We're very excited about new developments in the strategy as well as performance and the things that lie ahead. Bill?
Thanks a lot, Dean, and again, thanks, George. So just again, to wrap it up, this final slide of our performance, which we've discussed earlier, our team bios, Dean just highlighted the newest member of our team, Gary Julian, as well as our board, and our final disclaimer. If you could also now on the Q&A, feel free to follow the diagram and raise your hand, and I will unmute you so we can have a Q&A discussion. Thank you. Anyone for questions? Feel free to click off and raise your hand. Anyone? No one? Anyone? One final call for Q&A?
I think
Jay?
we dazzled everybody, George, and I think they've
Jay,
got
you
all
there?
their answers.
1 second, Jay. Do you have a question, Jay?
No, can you hear me?
We can. Go right ahead.
Oh, all right. I just wanted to compliment the team on a great performance and, consistency in the application of this strategy. I mean, it's the markets were obviously up and they've had a little bit of a dip in February, but I think that the results and the I guess the calibration against the benchmarks really demonstrate that you guys have been doing an outstanding job.
Thank you very much. We appreciate that.
So not really a question, but a comment and reflection on what you presented.
We'll take it. Thank you. Thank you very much. Anyone else? One final call. Okay. Well, thank you all for joining us this morning. We greatly appreciate your time and your interest. We look forward to being in touch at any point. Feel free to email me, anyone on the team, George, Dean, etc. We will be forwarding the replay information if you want to pass it along to colleagues as well as soon as that's available as well. So thank you and have a great day. Thanks.